You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we help you, the busy financial advisor and asset manager who wants to learn more about how you can use options in your clients' portfolios, as well as what the heck is going on in the world of options that applies to you. We'll help you break it down here on the Advisor's Option. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. A lot of great ways for you guys to get our content. If you're just new to the show and you want to go back into the archives, the best place to do that is actually our website, theoptionsinsider.com, or our mobile app available on your platform of choice, because that way you can dig deep into the archives to your heart's content. If you just want to subscribe to the show, have it delivered to your device of choice on your schedule, the iTunes, TuneIn, Stitcher, Pocket Cast, you can go to all those places and they'll have it too. And usually on occasion, we'll let you join us live via Mixlr as well. So lots of ways for you guys to catch the program, depending on your schedule. And however you like to listen, live, after the fact, whatever you end up doing, make sure you send in those questions, comments. We do enjoy hearing from you guys out there. That's how we plan the show. We like to hear from you guys. And joining me on the old program today, let's go in order of distance, going all the way out to the hinterlands of New Hampshire, where we are joined by my good friend, Mr. Matt Ambertson, the principal and CEO over there at ORATS, Options Research and Technology Services. Matt, welcome back to the Advisors Option.
Thanks, Mark. Wish I could be there with you guys, but New Hampshire in the summer, it's tough to beat.
That's what your buddy, Mr. Andrew, says about Maine in the summertime as well. So between the two of you and your connecting states there, you both love it up there in the summer. I can't really say that I blame you. And usually this is the part of the show where I toss it to scenic and sunny Puerto Rico. Instead, I'm going to toss it right next to me because I am pleased to be joined in the studio live in Chicago by Chris Hausman. He is the director of overlays and pretty much all things fun and interesting over there at Swan. That's what your business card says, isn't it?
Actually, it doesn't.
Major domo of overlays, is that what it says?
Something. I think officially director of risk management, but I'll take what I can get.
Major domo Archduke, I'll promote you here on the old program. Well, Chris, we're glad to get you in the studio. I can confirm to our listeners, as I confirmed to Matt earlier, you do indeed exist. You do exist in person. I have met you, seen you now in Chicago, so it's official. All right, we have a lot to get to, so without further ado, let's dive right into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. Like the name implies, this is indeed the portion of the show where we break down the buzz, the hot, interesting things that are going on in the world of options and derivatives that may pertain to you guys out there in the advisor space, because you know you're busy. You don't have time to pay attention to all this stuff, so we do it for you. And we just we're hot off the presses on a very interesting development in the world of options and advisors. In fact, this is the reason Chris is in town today. As much as he likes to see me, he's actually in town for the big Swan CIO Summit. Quite an event. People from all over the country coming in to really analyze and talk about risk and options and the use cases therein. Maybe, Chris, we'll start with that. Give our listeners a little bit of an overview of what this event is, what the point of it is, and kind of what the focus of this CIO forum is.
Yeah, so it was a good day. We had a good turnout. The overall purpose really is a chance for RIAs and asset managers from across the country to come to Chicago. You get to talk to the portfolio managers one-on-one and also have the majority of the investment management team here. So we've got all the research heads, the options department, risk department. Everybody's here in one-stop shop place. So it's really the only event that we do that during the year where we have all the top guys as far as investment management and portfolio managers gathered together. So, everyone has a chance to kind of pick our brains. And actually, it's an opportunity where we're going through real live due diligences because we're all together. So it's a good opportunity for potential investors just to kind of pick our brain and look inside and under the hood.
Probably a good chance for you guys over there at Swan to actually talk to each other in person, too, because you guys are in Colorado and Puerto Rico and Texas and Tampa, I believe. So a lot of different offices get to come together, a meeting of the Swan minds, if you will. I'm looking here at the agenda. It was a pretty dense day. Like I said, we just got out of it, so our minds are still swirling with all things a CIO forum. You actually had the unenviable task, Chris, of actually not quite kicking it off, but coming in right behind the second. So you're the second after the leadoff batter. You're the second guy, very early in the morning, doing a nice, easy topic like volatility. In particular, making vol great again. So why don't you tell us a little bit about what your presentation was about and how do we do that? How do we make vol great again, Chris?
So there's really two themes going on during the day, right? It's a chance to present solutions to investment problems. And then the other theme that was going on today was a lot about risk, right? I don't think anybody's surprised after the events in February. So, we had an outlier year in 2017 with respect to volatility, and then we had the events and all the volatility that we went through early part of this year. So I basically just kind of gave a primer on what volatility is, right? Difference between realized and implied, a primer on the risk premia, and then just kind of discussed what the overall themes of 2017 were and how volatility acted and that it was still a good risk premia harvesting year. And then what changed, right? I mean, with all the, we've discussed this on the show already many times, and kind of what changed, and kind of walk people through why that happened, and the effects of having, all these short volatility products out there. And really, the other theme was to know what you own, right? The nuances of different products. And I think people are starting to understand, hey, this options-based category is a fantastic thing that Morningstar has, but unfortunately there may be some products in there that not everybody knows exactly what's going on or how these options are being used. And so our job is to make sure that people are comfortable with options, that they know what they own, that they understand the risks. And that really was one of the topics and one of the themes today is, hey, this is how you perform in due diligence. I mean, I was up there telling people what due diligence questions to ask if they're going to start looking at option-based funds, et cetera.
Yeah, that was an interesting thing to see, because you're right, it is a fascinating time. I'm sure the lion's share, just seeing from the questions that were in the audience today, the lion's share of the questions you guys certainly get around the DRS, particularly after times like this, after these kind of tumultuous couple of months, are not going to be on the hedged portion, not going to be on the 2-year, 1-year rolling put. Everyone can usually wrap their heads around that. It's on the other side, the premium harvesting, which is where you spend the lion's share of your days working on that. I get to see even just from the crowd, when they're asking questions at the panels and things, that was kind of the lion's share of the discussion and the analysis. Is that your takeaway as well, or was that questions people were asking you maybe between sessions as well? Is it pretty much almost entirely focused around the income kind of portion of the DRS and how that plays out in times like this?
That's always been a focal point. I think really also the two things, right? What's the most appropriate hedge? And that comes with, okay, well, what's your problem and what kind of solution can we give you? But yeah, the income component, I mean, that's going to be the most volatile piece of the three stools when we discuss the defined risk strategy. So that is something that, if you're not an options trader or you don't have a background in options, sometimes that kind of volatility in those types of strategies is something that it takes a little bit more time to understand what the risks are, and also our processes and how we manage that type of risk.
Sure. People think hedged and they think, there's zero downside, right? They can't possibly have any downside in the portfolio. So I think an event like this is a good, explanation to those people about how that kind of stuff can work and what happens in some interesting markets like we have now. I'm curious for you. You're the guy who's managing a lot of these overlays. Do you prefer, let's say, the February through April markets, or the kind of long, languorous, slow VIX decline of 2017? Which is they each have their challenges. Which kind of environment do you prefer?
I like them both. I don't like when they change. That's the problem. That's the challenging part.
You like when it flips overnight on the 5th of February? That doesn't do it for you?
Yeah, exactly. It's like when you're changing these regimes and they're done so violently. I think that's the challenging time. But like we've said on this program before, I mean, low volatility, low implied volatility is not necessarily a bad time to harvest risk premia. There are some additional risks out there, just like we went through in February. But, the meteor, the sweet spot for us really is when that VIX is hovering around 15. So I would certainly like to see that we're going to hang around 12 to 15. Maybe we get some shots back at 18. I don't know. With what the market's done over the last week or so, it seems like volatility is starting to get comfortable right around here. But I wouldn't say that we're going back down to a 10 VIX anytime soon, or definitely not single digits. So, if we can hold low teens, mid-teens, that's really the sweet spot for, a lot of premium harvesting programs.
Yeah, that seems that's, of course, where we're looking today. We ended up right in the mid-teens again. VIX getting a little bit of life back after taking, I think the technical term is a drubbing over the better part of the past week. But, of course, it wasn't just your session there, Chris. There were a lot of different ones. You mentioned a lot of different panels talking with people, the CIOs of different pension funds out there, different panels. The one other panel you mentioned, which really was kind of interesting to me, ironically, you were on that one too, Chris. You were kind of the featured player today, was with you and Micah, who's been on the show before, kind of breaking down an issue that we've talked about on the show a lot here. I've often kind of half-jokingly referred to it as kind of the alts ghetto, where everything else that isn't a long equity or a fixed income, something like that, it's all kind of lumped into this one overarching umbrella of alts. And that could be managed futures. It could be, what you guys do, a hedged equity strategy. It could be some wildly speculative, and it's all lumped under the alts, which of course makes it challenging when people actually want to analyze this stuff. It's like, how do you compare hedged equity versus the managed futures, which is maybe long oil, versus something else kind of completely entirely out of left field? It makes it challenging. So you guys spent some interesting time on this one. And actually you had Typhoon, I think I'm saying that correctly, Ickton from Morningstar. By the way, listeners, if these panels sound intriguing to you, you'll be pleased to know that we captured pretty much all of them. I'm sad, Chris, the audio guys only got about half of yours in the morning session. So we got about half of your panel. So we'll see what we can do with that one. But the rest of them, we pretty much have all. So you'll be able to check them out on our network coming up in a little bit. So you can hear them all at your leisure if you want to get into them. And this one was kind of interesting because I don't think I've ever really heard a Morningstar analyst who, of course, have created a lot of the categories for a lot of these funds. They're kind of the arbiters of what fun categories are out there these days. He was actually breaking down things like put call parity and Vega. He's talking about the Greeks. He's talking about Iron Condor. So it was refreshing to have a Morningstar analyst getting into that amount of depth, which I thought was kind of interesting. Of course, he laid out all this great groundwork for how there are so many different options-oriented categories, but he never took the next step, and I think maybe the panel just ran out of time. I was hoping to ask him this question myself, actually, which is the next logical step to that is, of course, are we going to see more of these categories at a place like Morningstar? Because to a lot of the investing public out there, if it's not a category at Morningstar, it doesn't exist. So maybe breaking up the options-based category a little bit. Maybe you have a hedged equity portfolio. Maybe you have a just a hedging. Maybe you have an income. You have a collar. You have an Iron Condor. You can break it up in many different ways as you want. I'm curious. I don't know, Chris. You were on that session with him, so maybe if you have any takeaways from that session first, and then B. Do you think maybe Morningstar is moving down that track a little bit to finally opening up the options-based kimono, if you will?
Yeah, I definitely think they are going to open up that kimono because part of that panel was me demonstrating 5 different strategies, all of which are in the option-based strategy. So we looked at a traditional collar, a put spread collar, a short strangle. There was a call ratio 1/2. And each one of them has distinct risk-reward properties. So to put them all together, I've said it before on the show, is we need to make a better job. They need to make a concerted effort of trying to separate them what really is hedged equity versus just income only. Because, we went through an event that only happens every 200 years, right? On the panel that I was on, I asked everybody, the event of the VIX movement, if you're using a normal distribution, should happen, how long, how many years? And the probability that happening is 0.002%. And I had to look that up, and that's approximately every 200 years. And what I said is, what about Halley's Comet? Halley's Comet comes every 75 years and is due in 2061. And then I don't know if you remember, but I asked everybody in the room, who here thinks that the event that we just went through will not happen before the year 2061? And not one person raised their hand, meaning, hey, financial markets do not trade on a normal distribution. That's obvious. But it's understanding risk and understanding these products and how they feed off each other is extremely important. So, it was good to see that. I think Morningstar is listening. I think they've always been listening, and the next step is going to be breaking down that options-based category.
Matt, you'll be happy to know that on this session, Chris gave you a little shout out, or I should say, he gave your firm a shout out, but he also gave your favorite risk measure a shout out on the panel. He called out the debacle ratio. It's the first time I've heard it called out outside of this show in a public forum. So there you go, Matt. You were there in spirit, if not in person, sir.
You're making me feel good, Mark. But I think that's a good way to look at risk. You have to look at what you can lose if the worst case happens. So if you have a debacle ratio of only 20 and you're looking at returns, how are you going to compare those to a debacle ratio of 60, where you could lose 60% of your money? I mean, I think it's another way to look at the risk in your portfolio and then try to assess the outcomes. Because, after going through 2017, people are just piling on risk and just going for returns and really the not looking as much as I'm comfortable with, at least at what is the risk for your investment. You could get returns, but how far do you have to stretch? And we saw a few firms stretch too far in order to get those returns. So I think it's a good way to look at it, and I wish more people would calculate their investment strategies like that, Mark.
Well, another panelist, I forget which session they did kind of call out a similar feature. I think they cited Taleb and his off-stated fact that risk is not a drawdown. Risk is 100%. Risk is a total wipeout. That's what's really risk. Everything else is noise. So it's another spin on the debacle ratio. So a lot of people were playing up that same trend. Then we came back from lunch, Chris, and if you were in a good mood, that was John Malden. He really took it out of you. He shall we say, he was not the most upbeat of economists that I've heard out there talking about the impending debt apocalypse, and all sorts of other things that were coming on down the pike. So he took the level down a little bit. He was good. He was interesting, but I could definitely see him squeezing the air out of the room with the people out there because he was very dire in a lot of his outlooks. Then some interesting stuff with a lot of course, CIOs of different big funds and firms out there, which of course people in an event like this want to hear from. Then kind of interesting, I don't think you guys have done this before, correct me if I'm wrong, Chris, but you kind of wrapped it up with, because obviously the DRS has been around for 20 years. It's a strategy. People know it. They know kind of what the different variables and machinations of it are. But people have asked us, I'm sure they've asked you a million times, what other kind of flavors can we get with that? And you guys actually kind of broke this down. You guys and Mark Odo, who's been on the show before as well, kind of breaking down some different buckets you guys are creating, kind of like bespoke versions of the DRS. Walk us through those and kind of what you guys are doing to maybe make this a little bit more interesting or appealing or suitable to people who don't want just, let's call it the plain vanilla DRS.
Yeah, so one of the things that we've been doing is applying the DRS in a multi-asset format. I mean, right now, traditionally, on our major 4 mutual funds, we have large cap, small cap, foreign developed, and emerging markets. So what we're doing is taking that defined risk strategy and bucketing those together in a multi-asset form. So we have that in our collective investment trusts, which are suitable for retirement accounts, where we also have some fixed income products in there for people that just want income, they want moderate growth, they want just growth, or they want aggressive growth. So in the growth and aggressive growths, we include some small cap. We actually include some technology, which we do not have a dedicated technology defined risk strategy as of yet, and mix it up a little bit with the proper asset allocation for people that just don't want a large cap, small cap, emerging markets, foreign developed. So I think those products are a little bit sexier, offer another element of diversification over and beyond, the core defined risk strategy. So that's kind of what we've been doing those for several years now. In addition to, a lot of people have approached us lately like, well, you know what, the complete solution, the defined risk strategy isn't quite for me and what I'm trying to do. However, I like pieces of it. So we just pluck some pieces apart, and maybe people are interested in tail risk hedge, right? One of the things that as an asset manager or RIA, you have to decide, well, is left tail important? Is it moderate downside? Is it the grind lower? Is it yield that I want? Is it the grind higher? Or is it even right tail, is my problem the right tail? So what we're able to do is really, through our process and our checklist, is try to find the best solution, the most effective solution at the best cost for a client. So it doesn't necessarily have to be the full defined risk strategy that we implement.
It's got to be fun for you having to manage a variety of different bespoke type of strategies on top of the main one. But I guess it keeps you busy down there in Puerto Rico, sir.
When we don't have hurricanes, yes, then I fall back on that.
But yeah, I think it's kind of interesting because you're right, people have different needs, different interests. Maybe they don't want to be all primarily large cap equity. Maybe they want something else. They want to play with the allocation a little bit. Or I like the idea of maybe playing with different components of the DRS too. Maybe they want something a little bit different. So that sounds kind of interesting. I don't know, Mr. Max, listening to us here going on. By the way, Chris gets the Trooper Award because he's missing the reception to come talk to us here on the show. So at least he gets an adult beverage to do the show with. So he doesn't feel like he's missing out too much here on the program. But Matt, I don't know, have we sold you? Are you coming into the next one? It might be in Chicago or wherever it is.
No, it looks great. I'm looking over all the speakers that you had there, and of course Randy Swan was there, and then it looks like you had implementations for wealth management at the RIA roundtable. That looked pretty interesting to me as well. I'm wondering what the those types of are saying, the CFAs, the implementers for the wealth management. Are they are they gung ho about it? Or are they how are they? what was the feel for options, especially after February, is what I would ask.
Yeah, I did talk to a couple of people about that just kind of anecdotally at the event during some of the session breaks. And, different people, advisors, and what they're hearing from their retail clients, with some of the institutional and pension type people. And it did seem like anecdotally, granted, we're talking to people who are at a Swan CIO event, so they're going to be a little bit down the rabbit hole anyway. Yeah, it was kind of interesting to see that all of them kind of anecdotally all mentioned to me that they are seeing a large increase in demand and an upswell in what they're seeing out there. So that was encouraging to me as someone who's been watching this space from a big picture level for a long time. Has been doing this show for a while, and when we first started doing this network, it was the penetration was was negligible at best. So to see that kind of uptake and that amount of increase, I'm sure has been good. Chris, I know you're interacting with a lot of people at the event today as well. Is that kind of your takeaway as well? Obviously, these are certain people who are attending this event who are kind of already down the rabbit hole a bit. But are you hearing from them and just from interacting out there that the message is starting to get out there more, that people are starting to come on board with this the notion of utilizing options in some capacity? It could be DRS, could be whatever the heck they want to do, but using them in some capacity in their client accounts?
Yeah, there's absolutely no question that they want to employ option-based strategies. I think it's dipping your toe in the water. It's a new unknown for them, and especially with the events that happened in February, now they're asking, well, how do I really assess the risks of these option-based portfolios, especially when there's so many different types of strategies in one category. But yeah, this RIA roundtable that you're referring to, Matt, is it's a chance for the RIAs to get up there, and not just Swan people talking, but it's a good chance for them to tell us what their problems and how they're trying to find solutions, in a multi-asset world. And I think the general theme of that panel was like, they're looking for multiple investments during multiple times, and they're not into timing the markets, but they want things that are going to outperform during certain type of market events, market environments. And their job as asset managers is to get all these things together to produce one good product for their client. So whether it's Swan DRS or other option-based strategies, their goal is to vet those out, do the proper due diligence, and see where that fits in their overall matrix.
Well, yeah, it was a fascinating event. Like I said, you can check out the Swan website where they'll have the agenda up there. Stay tuned to our network. We'll have pretty much most, if not all, of the panels coming your way. Like I said, except for half of Chris's. So Chris got to give us the Cliff Notes version of it right here as well. Stay tuned to our special events feed, and indeed to our network feed. We'll have the shows there. Maybe we'll put them in this show feed as well. We'll see. And so you can stay tuned for that. So in case you couldn't make it to Chicago today, there you go. We got you covered here yet again. First OIC panel content. Swan panel content, we got you covered. We're doing all the traveling, so you don't have to. Even though the traveling for this one was pretty light. It was down the street a couple of blocks. I do appreciate you guys at Swan really planning this around my own personal travel schedule, Chris. It was very very considerate of you guys over there. So I'm going to return the favor now, Chris. I won't make you do any more prepared topics for a while. Instead, we'll just make you answer a whole bunch of questions because our listeners are chomping at the bit to get at us. So without further ado, we're going to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. That music means it's time for the office hours. This is, of course, a portion of the show where you guys take the reins, questions, comments, insights, pearls of wisdom, all of that fun stuff. We do like to hear from you guys on a variety of topics. Sometimes we turn the tables on you guys, and we ask you guys questions, like we did last week, actually, when we asked you, VIX was starting to settle off back into the mid-teens, but the volatility space in terms of products never been hotter. A lot of people are starting to elbow their way or trying to elbow their way into that VIX spotlight, given a lot of the headlines and news coming out of that product. So we asked you, which of these ones do you think has the best chance of actually hitting it big? There's the Real Vol product, our old friends on the volatility show there, where, of course, they're trying to create a realized volatility version of the S&P, so effectively a realized vol VIX. There was the folks over at Valdex, now part of NASDAQ, which is effectively VIX without the skew, which these days could have a little bit of a market, given some of the discussion points around VIX itself these days. There's the newest one, well, old but now new again, Spikes, which is, of course, the relaunched products coming out of MIAX. Now, it was initially out of BATS. This is effectively VIX on SPY as opposed to SPX. Or do you think that there's really only one VIX? There's no way to have a contender for it. And it seemed like VIX was winning, and then in the last minutes here, I think we had some Chicago-style vote manipulation because the folks over there at Valdex started driving a lot of votes their way, shall we say, and ended up being Valdex taking it with 44%, 24% saying there could only be one VIX. There could be only one. And 21% for Spikes, 11% for Real Vol. I don't know, Matt, maybe we'll start with you. I'm curious your thoughts. You test a lot of these products. You're looking at the space. Do you think there's room for some other players in that space now? I mean, it's been notoriously a tough nut to crack, even for SIBO, to launch additional VIX products. Not all of them have really taken off. So the vol space is notoriously tough to really get a home run in. I'm curious, do you think any of these products have a leg to stand on, or do you think maybe it's just going to be the kind of plain old VIX we have for the foreseeable future?
I've mentioned many times in the past on this show that, I'm very wary about new products and these products coming out. There's, and the simpler the better for me. There's just so many ways, because I have these clients, and I go into these client meetings, and they tell me off the record, where there might be some kind of hole in the back of one of these investment vehicles that they're and they're making a lot of money on it, that and they're really smart people, and they've figured something out, and all of these manufactured products, I think you have to be really careful as someone, you're at the poker table and who's the sucker type thing, and there are other people out there that have done so much more research and figured out things that I'm always wary of these products. So the simpler the better. So just if I had to say something, the at the money vol, that's a lot easier. I've always we've talked in the past about it's hard to tell exactly what's going to happen with the skew, but you have these options that are so far out of the money that it presents at least the appearance of a problem. I look a lot at realized volatility, but again, that's a difficult calculation. I mean, our firm, we've been profitable for a long time, even back to the 90s, coming up with our own way to look at realized volatility, where we would simulate having gamma and hedging that gamma and turning that profit into a volatility. So, you're doing what you would have done on the floor if you had a position in scalping your gamma and seeing how much money that you would have made off of that. So, all these things, realized vol, implied vol, even if it's at the money, there's so many formulas behind it that it makes it open to, some people with more information knowing more than you might and having an advantage. So, I would say if you're going to trade one of these, really, open up the prospectus, look at what they're doing, and back test your strategy, simulate your strategy, forward test it, and really concentrate on it. So that's my approach to these things, Mark.
Chris, do you have a dog in this alternative volatility product space, or do you think VIX is going to be the standard bearer for the foreseeable future?
Well, I mean, VIX is the heavyweight champ here, even though it's gone through some iterations during its 25-year history. But I would like to see a more pure at-the-money volatility metric, so that we're not dealing with skew and kurtosis and any other types of issues that may or may not be there as far as, the way the VIX is calculated today. So, but you know what, that still exists. It's called the VXO. It's not dead, just people don't use it. So if you do, and I still use it, I still look at it every once in a while. If you want a pure view of at-the-money volatility, that index is still out there. So, you can see whether skew is taking an effect or it's really coming from, your at-the-money options.
Yeah, they don't really talk about VXO too much anymore. But you're right, it is still out there for all of you who don't want the skew messing with your pure at-the-money vol. There you go. That's one for you. Here's one right up your alley here, Chris. This comes from Allan Tullman. He says, there's a lot of research last year regarding selling put options to harvest risk premium. Yes, you are correct, sir. It was at just about every conference I attended was harvesting the risk premium. Seemed like the entire industry awakened to selling puts over the last couple of years until about February. Allan goes on to write here, now that the volatility is back, is this an ideal time to harvest premium via put selling, or does the increased volatility increase the probability of getting whipsawed? Well, Chris, this is kind of your day-to-day here. You kind of just talked about this earlier, kind of your preference for different environments. We are in a little bit higher volatility regime right now. What do you say for Allan here? Should he be excited to harvest more premium, or should he be a little scared in this environment?
Well, I think it depends on what kind of volatility we're talking about. Are we talking about the nice, the porridge is just right, where the VIX is between a 12 and an 18? That's really the type of environment I want to look at. And again, Matt probably would agree with me, is like, I'm afraid of a VIX of a 30 or 35 because realized is going to be higher, right? Implied volatility is less volatile than realized, right? So it's going to, and Matt's mentioned this many times on the show, right? Implied is going to be slightly higher when realized is very, very low, and vice versa. Implied just isn't quite going to get as high as what it should be when realized is very high, because the marketplace knows that realized volatility is going to normalize. It's not going to stay high for a very long period of time, and the options market knows that. So I would say, again, it depends on what type of volatility is out there. You may want to harvest risk premium by selling puts, by taking some type of technical analysis. What major moving average have we continuously bounced off of in 2018? It's been the 200-day moving average, like 6-7 times. It's held like a champ. So I think if you're just going to be one-sided, meaning you're just going to be selling puts, I think you also need to perform some other type of analysis where you think, there's good support when volatility is high, and what's that going to do? If you can do both of those, that's going to increase the probability of a win.
Matt, you're the analysis guy. It's kind of what you guys do over there at ORATS. What do you have to say for Mr. Tullman here? Should he be worried? What is your data telling him?
Well, being a past market maker, I'm always worried, and I try to tell people that there is some skew to those puts, and it's there for a reason. And if you could buy something even more out of the money, try to limit your risk. That all comes down to the Dajakal ratio. You don't have to give up a whole lot to mitigate some of the risk. And then to Chris's point, I think, and also what Allan's asking is, this market with so many more vol sellers out there, they get it down quick, meaning they get the implied volatility down below even sometimes the realized volatility. I'm still sitting here looking at realized volatility, 13, and SPY and the at the money is about 10. So they've crushed the implied volatility, and the market's still moving. This intraday, ORATS measures intraday volatility. We think it's a better predictor than close to close in a lot of ways. I think that these implied volatility levels are low, and I think it's because a lot of the selling that has made so much money over the past years is really getting it down quickly. So I'd be wary of it, and if you do, then try to get some protection, Mark.
Yeah, you're right. It's fascinating to watch kind of the vol continue to come in as the underlyings are still moving. We're all selling off almost a full percent again today in the S&P. So it's been interesting, you're right, to watch all this unfold. Here's a little, I like sometimes when our listeners give us out of left field ones. This one comes from Charlie C. He says he has a quick question for the show. I don't know how quick this question, because this could actually be a very long question. He wants to know, what's the weirdest thing we've seen in the options market. I'll go first. I'll give you time, guys, a little bit of time to think. First off, I think what we just saw a couple of months ago with February 5th with that massive, the sell-off in and of itself wasn't weird. The response in VIX was certainly very interesting, at least, let alone the resulting tumult over all of the inverse volatility products just completely imploding. Again, not unexpected, so I wouldn't put it into the weirdest thing, but certainly a very low probability event and one that will probably not be repeated anytime soon, as we look at Chris's numbers from earlier in the show. So that one certainly is up there for just a weird overall experience in the volatility space. For me, I have to go back personally to some of my early days in the SPX pit in the late 90s when there was a lot of crazy stuff going on, and we're still in the go-go.com boom era. Yeltsin was dying every other day. That was the rumor anyway, so we'd see that coming through in S&P rumors all the time. This time it was real. Market selling off. Then we saw something happen out of the blue one time, which was kind of interesting. It was one of my first experiences with this kind of thing, which is probably why it resonated with me. All of a sudden, relatively quiet morning, and not that long after the open, all of a sudden, all the phones start ringing off the hook in the pit. And every broker in the pit is quoting out of the money puts. Everyone. And then one by one, all like, okay, what's your market? Okay, buy it. And they're lifting everyone's offers on every put. And the spoos weren't moving. Nothing was happening. It was very strange. To the point where everyone is chomping over themselves to sell these things, because people are lifting your offer on things. That's when you sell them. And for whatever reason, it seemed a little bit odd to me, because that, of course, is not a usual behavior when the S&P is not moving. And then, of course, the phones just were a little bit of a leading indicator there. Within a few minutes, the spoos started selling off like crazy, and the news that Rubin had resigned as Treasury Secretary some unexpectedly came out into the marketplace. And clearly that news had a little bit of information leakage there, because people had already picked off. By the time the guy said sold and then turned around to hit their spoos and to hedge themselves, the market was gone, and there was no coming back from that. And a lot of guys lost substantial amounts in that few minutes. So I guess, I don't know if that qualified for weird. That was maybe a little bit shocking, a little bit strange. Certainly resonated with me as a very young trader at the time, just how dangerous this game can be if you hit the wrong thing at the wrong time. And certainly interesting one that kind of informed a lot of my trading later on. So there you go. I kind of hedged. I had two things. I had the recent upside stuff in volatility space, and then, of course, that kind of aberrant moment. I could pick a lot from the SPX days, but that one really stands out to me as just being just a debacle for a lot of people, and I dodged that bullet very, very fortunately. Mr. Matt, we'll go with you. What would you say, again, not really a quick question, but an interesting one, what would you say is the weirdest thing you've seen in the options market, sir?
Yeah, I agree with you. There's so many head scratchers like that. Like all of a sudden someone knows it and hasn't hit the tape yet. The worst thing and the weirdest thing that I've ever seen is around the events of 9/11 in 2001, when they just came for every UAL put, and then and then we were sitting upstairs, and then watching what happened, and I just shook my head. I go, those bastards is what came out of my mouth, and I don't really know. I didn't really process what I said, but they knew, and it's like that was just the weirdest thing. And they, and then you would think that they could find those people that were profiting from this horrific event, but of course it never came to pass. So that, and then since there's been studies, Dr. J did a study. There's been another academic study that they said with the highest probability that there was foreknowledge of the events of 9/11 in 2001. So that was the weirdest thing that I've ever seen.
Yeah, I've had a few guests come in here off the record, tell me a lot of interesting things about those puts. All of them still scared to this day to talk about it, so they refuse to do so on the air. Maybe that'll be a special show we'll have to have someday. Because for a while there, you're right. People seem to play it off. Oh, it's just boxes going up. It wasn't these quote-unquote bin Laden puts that you heard so much about. Were really kind of just a lot of tinfoil hat stuff going on. But you start to hear a little bit more study analysis in more recent years. Seems like there might have been a little bit of some grist for the mill there. Chris, bought you some time there, sir. So what do you have to say here for, what was it, Charlie C? Weirdest thing you've seen in the options market, sir?
Well, I don't think this is the weirdest thing, but I go back over 20 years when I first started on the floor, and I was a young market maker, and being down on the floor in the mark when the Asian financial crisis occurred, and just seeing how volatility changed so quickly in the market pricing and being down there in the pit. And I mention that because there were short premium strategies that were blowing out at the time, right? Brokers were coming in and paying whatever they had to pay on puts because, these funds were being liquidated. And, 20 years later, we haven't really learned how to manage that risk because the story repeats itself, right? It's rinse, repeat. It's a new group of investors or traders or asset managers or whatever, but the mistake continues to be made over and over again where, we have to be able to define our risk. We have to be able to limit that risk because we're here, longevity is the key here, right, to have a successful strategy. So, a lot of these strategies look great on paper, but, like Matt says, there's risk inherent here. I'm worried about that. There's ways to cap that. So I don't necessarily, that's not the weirdest thing I ever saw, but it would definitely made an impression on me at the time. I think the weirdest thing for me as an upstairs trader was being assigned short calls when you shouldn't have been, but that was a welcoming event.
Those are great days, right?
I was going to say.
That's like Christmas come early.
I had to double and triple check, did I do something wrong? And then I was like, nope. I was like, well, I wish I would have been assigned a lot more of these.
Those are just little bonuses. That's like when you're working some scalp gamma hedges around earnings and you get filled at some crazy level for no reason, and you say really, and then you say thank you. So yeah, those are good memories. Here's one for you, Chris. This is kind of like what we were talking about earlier with the different types of assets you guys are doing the DRS on now. I guess this question was inevitable. This one comes from Seveny. He or she wants to know, when can we expect Swan Crypto? Sure would have been nice in the recent sell-off. So there you go, Chris. Break some news for us. When are we going to get the DRS on all things crypto, sir?
Well, I guess the question I have is crypto an investment or is it a spec? So, we focus on investments and long-term solutions. So if someone can tell me that crypto is going to be around 20 years from now, then I'd have a better answer.
You're no fun, sir. You're no fun at all. But you certainly, I'm with you. I could certainly question the underlying asset. But at the end of the day, also, you can't question its tradability, right? It's moving. So there might be, certainly, I think there would be some people hitting you up if there was indeed. The question is, of course, how do you construct it? And the problem there, Seveny, is there really are no legit listed options markets for crypto yet, which, of course, you need to have to implement something like the DRS. There's listed futures. There's some esoteric quasi-implied options you could trade out there if you're really in the weeds, but certainly not for the size you need to do for something like this. That's why I've been bugging SIBO, CME, and everyone else who would listen, saying, hey, when are we going to get these crypto options? So hopefully they'll listen, and we'll see them pretty soon. Doesn't seem like, from my conversations, I just had them again last week down at the Options Industry Conference, doesn't seem like anyone's really in a rush to list the crypto options for a variety of reasons. Primarily, it seems like they have to deal with the SEC, and that's a much longer process than dealing with the CFTC for the future. So that seems to be where we're stuck. I wouldn't expect, might not see crypto this year, options at least. I was hoping it would be end of Q2 into Q3. We're well into Q2 now, and so far no crypto options. So we shall see. Let's see. Here's an interesting one. Dajakal, I'm gonna go Dajakal. It sounds better. He's asking about ratio spreads. Is there a good rule of thumb for when to use a ratio spread and how much of a ratio to use? 2 times, 3 times more. Also, what is the best time or scenario for ratios? Good old ratio spread, very common, very popular. Different flavors, obviously, too. Usually the flavor, I'm assuming the flavor he's referring to here is the long 1, short 2, short 3, something along those lines, typically in the vertical, typically done to reduce the cost of the outlay of that one long leg. So you want to get long a vertical, and let's say Apple, but you don't want to pay as much as it's worth, so you sell 2 instead of 1, and next thing you know, hey, it's almost a free vertical. The problem with that is, of course, you can probably do the math, listeners. You end up being net short units to the upside or maybe to the downside, whichever way you're doing this, and that's where the danger comes. If people start learning about ratios, they get very excited, and then they start saying, wait a minute, I can get these positions on for even credits if I go 1 by 8. In fact, I think some funds that had some issues recently had similar leverage proposals going on in some of their issues, hence they're not around anymore after February 5th. So these are interesting. I think they can be a little bit dangerous to new options traders, which is why I'm kind of hesitant to go deep down the ratio spread hole. But Matt, maybe this is a good subject for back testing, and I'm sure you guys have gotten questions like this before over there in ORAT's lands. Have you, in your years of analysis and back testing, have you worked out maybe a good rule of thumb for for ratios, maybe other than don't go crazy being short units? That's probably a good rule of thumb for life for options trading. But outside of that, what do you have to say here for our friend Dajakal, who wants to know about ratio spreads?
Well, it's less risk than just being a naked put. So because you have a long one to start out with, to start the ride down if you're short a put spread or a ratio. But I actually like ratio spreads, but then you buy some teeny options or some small options with some of the proceeds. So that's the way I like to do it. So, and you could even craft a position that's has very limited outlay, but that still has long units, and can still help you on the downside. So there are some very interesting things that you could do with ratio spreads. But again, I'll always say, don't be short units is what I always used to tell my market makers that I backed, and same goes for individual investors. Just why not buy a farther out of the money put if you have a ratio spread, and if you do it that way, then it's a lot less risk. You sleep easier. And you could even make money in a lot of the different scenarios of the market, and using a ratio spread the right way. And there are times, given the skew and kurtosh and such, that you could find the sweet spot on the skew, and that's important as well. So I think there are times for ratio spreads, but find a little option out of the money or a bunch of them. You could do 1 by 2 by 3 for credit still. So that's what I would suggest, Mark.
But Matt, then you're spending all that juicy credit premium to buy more options, right? Then that's defeating the whole purpose. They want to get it all for free, sir. But
it's a sleeping pill.
Yes, exactly. What could possibly go wrong with being net short all those units? Mr. Chris, I believe you said something similar to this on the panel today about how you're not a fan of being net short units. So what do you have to say for our friend here, Mr. Dajakal, who wants to know when should he be slinging ratio spreads?
I think this strategy is good if you have a price point for a certain stock and you want to own it. So, there's the embedded long put spread, and then you're short that extra put. So if there's a stock that you want to own at a certain price, ratio spreads are a good vehicle to do that.
Yeah, the scenario I always give for kind of the cliche, prototypical great setup for your typical long call vertical spread was the old Apple days when the skew would get bid up to like high heaven, right, ahead of earnings. So you could get into verticals and even ratios for just extreme levels, certainly credits at that point, because people were bidding up those calls like crazy. But I would never do it naked short units because Apple could surprise to the upside at any time. So, of course, the Matt route of having some extra calls farther out of the money, just to flatten out your units risk at the very least, is always the way I would go. But those are kind of the cliche, typical scenarios. We also see the reverse. It was very popular in VIX for a long time. The short one, long two to the vertical side, where they're selling one near at the money call in VIX, and then buying two farther out of the money. Remember, VIX, the name of the game in VIX often is managing your table stakes until you get that big explosion like February 5th. So that kind of trade was a great way to do that because you're actually collecting a little premium or doing it maybe for a very negligible outlay, and now you have a position that's going to do well if VIX kind of just sits around, not going to really hurt you too much. But if it takes off, then that's where you really got the net long unit kicking in that could help you out. So that's where we've seen actually some of the reverse ratios actually be very useful. That trade of late hasn't been too popular. Now that VIX is back lower a little bit again, maybe we'll see if that trade comes back into fashion. Let's see. Here's an interesting one. Chris, this might be kind of an interesting one for you because you guys are trading all sorts of different time horizons. Duffy wants to know, how do you handle the fixed time aspect of trading options? Most of my client strategies have a 1 to 2 year time horizon, so trading a 1 or 3 month option doesn't really suit my needs. Well, actually, Chris, you guys are probably uniquely qualified to talk on this because you're some of the few I know who routinely trade in that time frame, that 2 year time frame. So what do you have to say here for Duffy? Sounds like he's leaning more your length in terms of his duration of his trades.
Yeah, I mean, if this is about hedging a portfolio, then, if your time frame is 1 to 2 years, there's issues with shorter term type hedges. Now, every hedge has its day. what you're trying to do is alter the distribution of returns. So we like longer term hedges because of, well, the cost effectiveness. There may be more cash outlay. For example, it may cost you 7 to 8%, but you're not losing 7 to 8%. And historically, a drag for a longer term option is about 3 to 4% per year. If you go with shorter term options, 1 month, 3 month, I mean, a 3 month, 5% out of the money put under normal volatility environment could cost you anywhere from 6 to 8%. And the problem with shorter term options is the stair step down. If you do an option, if you have a hedge that's 5% out of the money, well, what if the market goes down 4% every month or every 3 months or what have you, and you have to reset and then reset and reset. Unfortunately, some of those resets could be when you need protection the most, when you need something that's going to reduce the correlation in a portfolio the most. But that could be very cost prohibitive. So that's something that you have to take into consideration between short-term hedges and long-term hedges. Now, to be fair to long-term hedges, they just don't provide the convexity during these short, volatility downdrafts. The market's down 5 to 10% in a 1 to 2 week time frame. You're not going to get that kind of protection from a longer-term option. So, like I said, every hedge has its day. But over the long run, if you are interested in bear market scenarios, something that's going to last months, if not years, then longer term hedges would be suitable for that type of scenario.
And remember, if you're going out of the money farther out, listeners, that delta's getting smaller. So bear that in mind. You get a day like February and you're 2 years out, you're not going to see a huge pop. You're going to see a pop in those puts, but not like if you're in the weeklies. So something to keep in mind as you're playing around. But you get all the trade-offs there, like Chris just mentioned. Matt, I'm assuming this is probably a pretty frequent question for you guys from a lot of your institutional users, where kind of that optimal sweet spot is. Do you get a lot of people asking about this long of a time frame, 2 years, or are they more in like maybe the 1 to 6 month camp?
Not a lot of this long of term, but like Chris says, every hedge has its day. So this allows you to have maybe 2 or 3 strategies that you could apply to for a client, and to show, and then the fixed time aspect, you could overcome that a little bit with just showing them the performance, through a back test. You could show them, how it performed in various market scenarios, and then it's true what you say, the delta, the farther out of the money that you go, but if you could pick up way out of the money options and you do get an event like in February, those things, even though the market doesn't go down that far, the Vega components of those puts really blow up. And so that does provide some protection. I mean, that's what we saw in the Tesla puts too. The way out of the money Tesla puts, even though Tesla hasn't gone near there, they've blown up. So there are interesting things that you can do for people that have various time frames, and you could show them through back testing kind of what they can expect, Mark.
Are you referring to our old friends, Matt, the Tesla Jan 2019 50 puts? Because you're right, they had quite the Vega kick-in, shall you say. They about doubled in value over the course of more than that, in the course of a month, even though they're not even close to being in the money. So yeah, those are fascinating. You're right. There are interesting things at work. We could probably do a whole show about maybe that's an interesting topic for a future show. Long-term options and how to play in and around those markets. See, that's why we like answering your questions. You give us ideas for future shows. Unfortunately, that music means we've come to the end of an hour. Amazing how fast it flies by. I could tell for Chris, if he had to answer one more question, he would fall off his chair. He's been talking all day, listeners. So I'm going to cut him a break and not ask him one more, even though I was tempted. We won't go that way. Instead, Chris, we'll just do this. I mentioned the audio is coming out on our network soon, so they can stay tuned for that. But if listeners want to learn more about maybe a forthcoming Swan CIO event, I know you guys are also doing the 10th box stuff. Where should they go? What should they do?
Yeah, we're still continuing with the 10th box, so you can go to our website. That's 10thbox.com. As far as our next CIO, well, we just finished this one up, but I'm sure the plans are already in the making for the next one. So hopefully it's going to be back in Chicago again.
That would be nice. Certainly the commute for me is very manageable indeed. We'll have to get Matt in the Windy City again. We'll all go out for steak or pizza or cigars. Maybe all three. Who knows? That'd be kind of fun. And Mr. Matt, you guys are always cooking up cool things over there in the land of Orats. What do you guys have up your sleeve as you're working away over there at Orats? Mr. Matt, sir, did we lose you? Did we wear you out from all this talking?
I did the energy Illuminati. I do that once a year, but we had a good earnings season. You pushed us into that earnings report, and we made some signals, and it came through this season. So that was a lot of fun. Our back testing is more popular than ever. We're continuing to add to it, adjustments. Being able to change the look of the strategy as the market moves. And now we're actually implementing the strategy. So you could click on a back test and it'll show you all the options. And then when you trade it, it will look for exits for you and tell you when to get out. That's a lot of the problems that we saw in the Cirilli study was how long it takes to manage these option positions. But we're trying to alleviate some of that chore and go from strategy to implementation to review, and that's what we're working on here at ORATS, Mark.
There you go. Check it out, listeners. You're right. Those earnings reports were a home run. You can find them over there at ORATS, the blog, or, of course, the Options Insider. We have them all there, too, to search for ORATS in the search bar, ORATS. You'll get your fill. It's all the stuff you guys have been bugging us for forever. The average move, how much they move, and a lot more. Matt and his team really went above and beyond. And the best part, it's free. You can't beat the price. So if you're at all you people who've been hitting us up for years, how does this name perform during earnings? How does it compare? How does this straddle compare to last year's? All that stuff, it's all there. Check it out over there. And we'll see what they got going on over there at ORATS. And of course, our friend Eric from OIC once again couldn't join us. He said he's still worn out from the big OIC conference last week. I can't really say I blame him, even though I think I talked a lot more than he did down at that conference. But c'est la vie. My voice is trained, apparently. But check out over there, optionseducation.org. Hit the advisor tab to see all the cool. They have some new studies coming out. I know you guys love your studies out there. So some new study to arm yourselves with data when you're talking to clients. It's the best thing to have. So check it out, optionseducation.org/advisor. And on behalf of Matt, who stayed up late for us, and Chris, who held off on a reception to join us, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course, for sending in such great questions. We love them. Keep them coming. And we'll see you next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.